What if I told you the wait is over? The rumors, the filings, the endless speculation, they've just crossed the line into history. XRP now has its first spot ETF approval, and that single decision changes everything. This isn't a drill. This isn't another round of hype or guesswork. This is the moment the XRP community has been preparing for, and the tsunami of capital that's about to follow is unlike anything we've seen before. For years, people said it would never happen, that regulators would block it, that institutions would never take XRP seriously. And yet, here we are. The dam has cracked and the flood is beginning. Before we dive into the details, let me be absolutely clear. This is not financial advice. I'm not your financial advisor. Everything I share with you today is for educational and informational purposes only, designed to help you understand the mechanics of what's happening and why it matters. Always do your own research and never invest more than you can afford to lose. Now let's talk about the real story, because for the first time in history, we're not just talking about if an XRP ETF will exist. We're talking about who has already pushed it across the finish line. REX Shares, a player most people overlooked, just launched the first ever spot ETF that gives institutional investors direct exposure to XRP. At the same time, Osprey's XRP Trust, which has been quietly sitting on the sidelines for years, is finally coming into the spotlight, now legitimized by this wave of approvals. And it doesn't stop there. Hashdex, working directly with NASDAQ, has rolled out its diversified crypto index ETF that includes XRP as one of its core holdings. That alone is groundbreaking. XRP, listed alongside Bitcoin and Ethereum, inside a regulated mainstream investment vehicle on one of the biggest stock exchanges in the world. And while these dominoes are falling, Amplify has already filed for an XRP-specific ETF, which means we're not looking at an isolated event. We're looking at the start of a floodgate being opened, one ETF at a time. Let's put this into perspective. Bitcoin ETFs were fought tooth and nail for over a decade. They only got through once massive institutions like BlackRock forced the issue, and even then it was considered the biggest breakthrough in crypto history. Ethereum followed, with its spot ETFs being hailed as a turning point for altcoins. And now XRP, the so-called underdog, the asset that was dismissed, attacked, and put on trial in the public arena, has joined the ETF ranks. The SEC just approved the first wave of products that include XRP exposure. That's not speculation. That's not a rumor. That's on the record. Think about what that really means. It means that for the first time, institutional investors, pensions, hedge funds, family offices, even conservative mutual funds can allocate to XRP without touching a crypto exchange. They don't need to worry about custody. They don't need to manage wallets or private keys. They can buy regulated shares through their existing brokers, custodians, and retirement accounts. That one step flips the switch from a niche crypto play to a mainstream investable asset. And let's be honest, that was always the missing piece. Retail traders can only push an asset so far. The wild runs of 2017 and 2021 proved that speculation can move prices, but it also showed how fragile retail-driven rallies can be. Institutions are different. They don't buy in hype cycles only to dump the next week. They allocate billions methodically, they hold long-term positions, and they rebalance quarterly or annually with staggering amounts of capital. That's the kind of flow an ETF unlocks. That's the tidal wave behind the word tsunami. Now here's the kicker. This isn't just about XRP getting included in some small trust fund. We're talking about XRP being legitimized by multiple issuers across multiple ETF structures at the same time. REX Shares is giving it the spotlight as a pure spot ETF. Osprey is leveraging its long-standing trust structure to finally attract flows now that the regulatory environment has thawed. Hashdex and NASDAQ are plugging XRP into an index that institutional investors can access as easily as they can by the S&P 500. And Amplify is already preparing to go live with an XRP-specific ETF, which means more issuers, more products, and more demand are inevitable. Once the first domino falls, the rest topple quickly. That's the playbook we saw with Bitcoin. That's the playbook we saw with Ethereum. And that's exactly what's happening with XRP right now. Let's also address the elephant in the room: timing. ETFs don't just launch in a vacuum. They launch when conditions are right, when institutions are clamoring for access, and when the underlying asset has enough liquidity and infrastructure to support large-scale flows. The fact that XRP's ETFs are debuting now tells you everything. It tells you that institutional desks are ready. It tells you that custodians have their rails in place. It tells you that regulators, despite their battles with Ripple, are acknowledging that XRP is too integral to ignore. The market has matured, the infrastructure is ready, and the ETF approval is the signal flare. For the XRP community, this is vindication. For years, we've listened to critics call XRP a banker's coin, a security, a dead project. We've seen lawsuits weaponized to delay adoption. We've seen exchanges delist and relist. Through all of that, the XRP ledger kept running. Banks kept building. Institutions kept testing corridors. And now, after all that noise, XRP has forced its way into the most legitimate mainstream investment wrapper in existence, the ETF. But here's where it gets even more exciting. ETFs don't just validate an asset, they amplify its demand. When a new spot ETF launches, market makers must acquire the underlying asset to match inflows. If 500 million flows into Rex's XRP ETF, that means $500 million worth of XRP has to be purchased on the open market. Multiply that by Osprey, by Hashdex, by Amplify, and by the other issuers who will inevitably pile in, and you start to see why Tsunami isn't an exaggeration. Every dollar of inflow translates into real buying pressure. And when the float on exchanges is already thin, with so much XRP locked in escrow, in long-term custody, or held off market, that pressure doesn't just push price higher, it rips it to new levels. This is the opening salvo of a new era. ETFs for XRP aren't just a checkbox on some institutional investor's wish list. They're a gateway to systemic adoption, a bridge between Wall Street capital and blockchain rails. And once that bridge is open, the flows don't stop. They compound. Let's break this down to the mechanics, because once you understand how ETFs actually create demand, you'll see why this approval is not just another headline. It's a structural shift that could redefine XRP's price action permanently. Here's how it works. When an investor, whether that's a pension fund, a hedge fund, or even a retail investor inside a brokerage account, buys shares of an ETF, the ETF provider can't just sit there holding cash. They must go out into the market and either already hold or immediately acquire the underlying asset to back those shares. For a Bitcoin ETF, that means market makers have to physically buy Bitcoin on the open market. For an Ethereum ETF, it means the same thing. ETH is purchased, custodied, and locked. Now apply that logic to XRP. When Rex Shares XRP ETF or Hashdex's diversified fund receives inflows, market makers are forced to buy XRP itself. There's no shortcut, no workaround, no paper trading substitute. They need the real asset. That demand gets funneled directly into the spot market. It's mechanical, it's relentless, and it has nothing to do with speculative hype. It's simply the function of ETF creation and redemption. This is why Bitcoin ETFs triggered billions in inflows within weeks of launch. Investors weren't just betting on Bitcoin, they were accessing it through regulated wrappers. And the ETF providers, bound by law, had to go acquire the asset to match those flows. The result? Spot demand spiked, and price responded accordingly. The same happened with Ethereum ETFs, albeit at a smaller scale. And now, XRP enters the arena, but with one key difference. Unlike Bitcoin, XRP doesn't have a constant stream of new supply entering the market. Bitcoin has miners, Ethereum has validators. They produce new coins daily, feeding liquidity back into exchanges. XRP is different. It has a fixed supply, with large portions locked in Ripple escrow or in long-term custody wallets. That means the actual float available on exchanges is far thinner than most people realize. When market makers need to buy XRP to back ETF inflows, they'll be competing in a shallow pool, and shallow pools don't absorb waves, they amplify them. Picture this, $1 billion flowing into Bitcoin ETFs barely moves the needle because the market cap is so massive and the mining supply trickles in daily. But $1 billion flowing into XRP ETFs, where the exchange float is limited, could have an outsized impact. Every incremental inflow tightens the screws, pushing price higher because supply simply isn't there to meet demand. That's not speculation, that's math. Let's compare numbers. When Bitcoin ETFs launched, the first few weeks saw billions in inflows, sending BTC from the $40,000 range into the $60,000s almost instantly. Ethereum, with a smaller market but still steady validator issuance, also saw a lift as ETFs went live. XRP, by contrast, has roughly 100 billion tokens in total supply, but a huge portion of that is locked in escrow or held by institutions. The liquid float is a fraction of the headline number. Analysts estimate that less than 10% of total supply is actively circulating on major exchanges at any given time. That thin float is the tinderbox. Now add to that the psychology of institutions. Pension funds and insurance companies aren't chasing meme coins or trying to scalp 5% moves. They're allocating billions in systematic strategies. When they get access to a new ETF, especially one tied to a settlement asset like XRP, they don't drip in $10 million here and there. They establish positions in size, sometimes in the hundreds of millions, because they're rebalancing entire portfolios. That's where the tsunami metaphor becomes real. It's not a flood of retail speculation. It's the slow, steady, crushing force of institutional capital moving through a narrow channel. And once these inflows begin, they trigger secondary effects that most people overlook. First, price discovery accelerates. As ETFs lock up more XRP, fewer tokens remain on exchanges. That scarcity forces price higher, which then attracts more inflows as performance chasers pile in. Second, arbitrage mechanisms kick in. If ETF shares trade at a premium to the underlying XRP, authorized participants rush to buy XRP on the open market to create new ETF shares, capturing the arbitrage. That process itself requires more spot XRP buying. It's a feedback loop. This is exactly what we saw with Bitcoin ETFs. Premiums and discounts on ETF shares creating arbitrage opportunities that pulled in even more spot demand. The difference is that Bitcoin's liquidity could absorb it. XRP's liquidity is far thinner, which means the same mechanics could drive more violent price moves. A 5% inflow shock in Bitcoin could mean a 20% or 30% inflow shock in XRP. The multiplier effect is that strong, but it doesn't stop there, because ETFs don't exist in isolation. Every approval is a signal to other issuers. When Rex shares goes live, Osprey and Amplify move faster. When Hashdex integrates XRP into its index, competitors like Grayscale, VanEck, and even BlackRock are forced to consider similar products or risk losing market share. That domino effect means that today's approval isn't just one ETF. It's the beginning of a chain reaction where multiple issuers pile in, each one amplifying demand. The Bitcoin ETF saga proved this. The first one opened the door, but within months, there were a dozen, each attracting billions. Expect the same for XRP, only faster because the blueprint has already been written. Now here's where the structural difference comes into play. Bitcoin ETFs tapped into an asset that was already considered a macro play. A hedge against inflation, a digital gold. Ethereum ETFs tapped into the narrative of smart contracts and decentralized finance. XRP ETFs, on the other hand, represent the first mainstream investment wrapper for a token designed explicitly for payments and liquidity settlement. That narrative matters. Institutions aren't just buying exposure to an altcoin, they're buying into the infrastructure of global finance. That positioning is far more palatable to conservative allocators than chasing yield farms or meme tokens. And that narrative alignment could accelerate adoption in ways Bitcoin and Ethereum never experienced. So where does this leave retail investors? In a strange way, the ETF approvals create a paradox. On one hand, they validate XRP, bring institutional legitimacy, and unleash new waves of demand. On the other hand, they also reduce the window of opportunity for retail. Once ETFs begin absorbing supply, the easy accumulation phase ends. Price begins to reflect institutional flows, not retail patience. That's why these approvals are both a celebration and a warning. The tsunami isn't just coming, it's already forming offshore. By the time most people see the waves on the horizon, it'll be too late to position at today's levels. The mechanics are clear. The math is undeniable. ETFs don't just mirror price, they drive it. And for XRP, with its thin float, its fixed supply, and its growing institutional rails, the impact of ETF inflows could be unlike anything this market has ever witnessed. Now let's zoom out, because ETFs aren't happening in a vacuum. They're arriving at the exact moment when global liquidity is shifting gears. And if you've been following macro investors like Raoul Pal, you'll know they've been calling this the beginning of a 5-year supercycle. What does that mean in plain language? It means we're not just looking at one bull run. We're staring at a structural wave of liquidity, technology adoption, and institutional repositioning that could carry risk assets, especially crypto, far beyond anyone's current expectations. Here's why the timing matters. Central banks, particularly the Federal Reserve, are moving into rate cuts. Each cut isn't just symbolic. It has real effects on capital flows. Cheaper borrowing costs free up liquidity. Investors shift out of low-yield treasuries and into higher-yield opportunities. Risk assets, equities, emerging markets, and yes, crypto become the natural outlet. Now layer in tokenization, ETFs, and cross-border settlement infrastructure, and you've got rocket fuel. Bitcoin ETFs proved the point. When they launched, inflows surged even as macro conditions were still shaky. Institutions were clearly hungry for exposure. Now, as XRP ETFs come online in the middle of a liquidity expansion, the impact could be magnified. Because unlike Bitcoin, which is often treated as a store of value, XRP sits at the intersection of utility and speculation. It's not just digital gold, it's the settlement layer for trillions in potential tokenized assets. That utility gives it a fundamentally different adoption curve. This is where the supercycle framing comes in. Traditional crypto cycles, 2013, 2017, 2021, were largely driven by retail hype, halving schedules, and speculative mania. They rose fast, crashed hard, and reset. But analysts argue that the next 5 years could look very different. Instead of boom-bust cycles, we could see overlapping waves of adoption. ETFs driving institutional inflows, tokenization of real-world assets adding utility demand, central bank digital currency pilots boosting settlement volumes, and cross-chain ecosystems like Flare deepening liquidity. Each wave builds on the last. Instead of one vertical spike, you get stair-stepping parabolas, shocks, consolidations, higher baselines, then the next leg. Now put XRP in that structure. When ETFs start pulling supply off exchanges, you get your first shock. Price gaps higher, retail piles in, institutions allocate bigger blocks, then tokenization pilots, real estate, treasuries, equities start to flow through XRP rails. That adds a second wave of demand, not speculative but functional. Settlement corridors light up. Banks and fintechs begin integrating XRP for efficiency gains. Suddenly, you've got two demand vectors compounding. Now add a third wave, liquidity staking, wrapped assets, and Flare smart contracts unlocking new yield strategies on top of XRP. That's an ecosystem effect. And unlike past cycles, where utility lagged hype, this time utility is arriving alongside hype. That convergence is why analysts talk about a supercycle rather than a bubble. Think about history. In 2017, XRP exploded from fractions of a penny to over $3 on nothing but speculation about banks maybe using it one day. There were no ETFs, no ISO 2022 adoption, no tokenization pilots, just hype, and it still delivered one of the largest moves in crypto history. In 2021, despite the SEC lawsuit clouding the asset, XRP still experienced violent spikes as traders refused to ignore its network potential. Fast forward to now, the lawsuit is essentially resolved, ETFs are launching, and the global financial system is actively integrating blockchain rails. If XRP could do $3 on hype, what can it do on systemic adoption? Here's another way to frame it. Every supercycle has its flagship assets. The dot-com boom had Amazon and Google. The commodities supercycle had oil and gold. Crypto's previous cycles crowned Bitcoin and Ethereum. This next one could crown the settlement layer, the asset that underpins trillions in tokenized flows, and that crown may belong to XRP, not because of speculation, but because of math, adoption, and necessity. If tokenization is going to scale, institutions need rails that are cheap, fast, and reliable. XRP fits that bill better than any other large-cap crypto. Now consider investor psychology. Most retail still thinks in terms of catching the next meme coin or waiting for Bitcoin halvings. They don't realize that the market is evolving into a two-tier system. Speculation on one side, institutional settlement on the other. Bitcoin ETFs captured the first tier. XRP ETFs are opening the second. And once that second tier becomes visible, when investors see banks using XRP, ETFs absorbing billions, and tokenized assets clearing through its rails, and the narrative shift will be unstoppable. Suddenly, XRP isn't just another altcoin. It's the plumbing of global finance. And once that perception sets in, valuations can re-rate dramatically. But let's not forget the psychology of disbelief, because that's where we are right now. Most investors are bored of XRP. It's been range-bound, overshadowed by meme pumps and AI tokens. The ETF approval barely registers for some because they're chasing volatility elsewhere. But that's exactly how supercycle moves begin. In silence, in disbelief, with most of the market looking the other way. Then, when the first shock hits, disbelief flips to FOMO, and capital floods in late. That transition from disbelief to acceptance is where life-changing wealth is created for those who were prepared early. We've already seen the early signals: liquidity draining from exchanges, whale wallets accumulating, institutional language shifting from if to when regarding tokenization. Even central banks are openly discussing how distributed ledgers can improve cross-border payments. These aren't hypotheticals, they're the scaffolding of the supercycle. And ETFs, by providing the bridge for institutional capital, are the spark that lights the fuse. So here's the bottom line for Section 3. The XRP ETF approval isn't just a milestone for one token. It's a catalyst timed perfectly with macro liquidity, institutional adoption, and technological convergence. Bitcoin had its moment. Ethereum had its moment. XRP's moment may not just be a spike, it could be the foundation of the next 5 years of financial infrastructure. That's what a supercycle means. And if you're positioned correctly, it's not about catching a pump. It's about riding a structural wave that could redefine what's possible for an entire asset class. Now let's bring everything together. We've talked about ETFs as the gateway, the liquidity backdrop fueling a supercycle, and XRP's unique positioning as the settlement layer of tokenization. But here's the part most people miss. This isn't just about charts, tickers, or price predictions. It's about structural change and how money itself moves. And when money changes, everything else, markets, industries, even governments, eventually follows. That's why XRP's moment is so different. For years, crypto has been treated like a sideshow, a speculative playground for retail investors. Bitcoin was digital gold, Ethereum was programmable money. But the conversation always stopped short of the real prize, becoming the infrastructure of finance itself. Now, with ETFs legitimizing the space and tokenization entering the mainstream, we're not just speculating anymore. We're watching the plumbing of the global economy being rebuilt in real time. And XRP sits at the center of that architecture, like comment and subscribe.